Hello and welcome to the DIY Investing YouTube channel. We are going through every company in the S&P 500, and today is Albemarle Corporation, ticker ALB. In the next 5 minutes, you will learn about the valuation that I think this company should have and what I think of the business quality. Let's dive on in. Today, we're looking at a chemicals industry company. So that tells us a little bit about the business, but the business description here on QuickFS helps us understand what more about the company. So they are a chemical manufacturer, here by saying it's a manufacturing company focused on specialty chemicals. So remember, specialty chemicals are different from more general chemicals. You're going to see higher margins generally, more lower volumes. Operate in 3 segments: lithium, bromine, specialties, and catalysts. That's basically all you need to know about the business description to get some idea of what they're doing. The beta 1.5 being that much greater than 1 tells it's a lot more volatile than normal, and the share turnover for 220%. Pretty standard for an S&P 500 company, so it doesn't really tell us much. Where I really want to learn about the company in terms of business quality is return on invested capital. And the first thing that I see when I look at this is 2 things. One, they are profitable every year for the last 12 years or 20 years. That's a very good positive sign. If you can go 20 years without having a single loss, that shows a level of quality in your company. The next thing is there's a lot of volatility in this return on invested capital. You don't see a stable line. You want it to be as stable as possible. So if it stayed around this 9% number, that's okay. But it goes from 8% down to 4, then back up and eventually to 11. You peak at around 15% in 2011. Before bottoming in 3% in 2014, 1% in 2017. And so you're kind of all over the place. So there's not a lot of stability in the bottom line. I don't really know what it is, but it suggests a very cyclical company. The next way that we can get an idea of kind of the quality here is to look at the gross margin percentage. And we don't care that this is 30 in the 30s. We care about how stable the gross margins are. So it starts at 33%, 35, 35, 31, 30, 36, 36. So this is the problem. You're dropping from 35% to 31% in a single year. And then you go from 31% to 36 in a single 6% in a single year. That's not stable. That's almost a 20% increase or decrease in gross margin in a single year. And so that shows how cyclical the company is. Because if your gross margin is that cyclical, your operating profit is going to be way more cyclical and unreliable. And so you see how they begin the decade at $518 million in operating profit, and they end the decade at $500 million in operating profit. And so that's a bad sign. I don't like to see that. The 10-year median returns, return on equity of 15% should be acceptable, but we've already seen that it's all over the place. So that 15% isn't a stable number. It's because you're averaging out both highs and lows. So originally that might be okay, but on a compounded basis, it might not be this good. PE ratio, if this 130 is real, then that's completely unreasonable. You never want to pay a PE over 100. You certainly don't want to pay a PE over 50 or 30. Again, I like to target 15, so I'm immediately thinking this company is overvalued. We'll look at that a little bit differently, but you can know that it's not completely out of the water as overvalued because the price to sales is at 8. Price to sales of 8 is very high. I would never pay price to sales of 10 for any company, and we've already said this is somewhat of a cyclical company, so I'm not impressed at all about the P to S of 8. Now, the only way to make something like this work is with massive revenue growth, but we can see that the revenue growth is of 2.8% over the last 10 years. That's quite slow, and your EPS is flat, as I already outlined. Meanwhile, your assets are growing at 13%. What this tells me is that you're going to have increasingly lower and lower returns in the future. So from already what I've seen after 4 minutes, this company is a pass. I wouldn't work any further on it. Now, we can give you a little bit more information by looking at a few other things that could be helpful. So I want to go to see the balance sheet. Are they funding this with debt? So you can see the debt's grown from $852 million up to $2.7 billion in a decade. So they've tripled or quadrupled their debt. And the PP&E, basically the property, plant, and equipment, has gone from $1 billion to $5.5 billion. So it's gone 5x up in assets over that period. And yet, so you've increased assets 5x, but your income statement is flat. That's very bad. Your income statement is worse than flat. You started the decade at $392 million, and you're currently at $200 million. This is terrible operating business. This business is going to keep getting worse. Not only that, is they're diluting you. If you look at your shares outstanding, you've gone from 91 million shares outstanding to 106 million shares outstanding. When we look at this on a net income basis, let's call that 200 million. What is our size of the business? 27 billion. Yeah. So this PE number is actually real, and it means this company is completely uninvestable. So I would pass on Albemarle myself. It wouldn't even make a watch list because the company is way too cyclical for me, and there's no stability on the gross margins or the operating margins. In addition, the growth rate in these assets means the business continues to get worse each and every year. I hope you have found this useful. Hit that like button on this video, and don't forget to subscribe and ring the bell in order to get notifications as I upload future videos. Thank you for listening, and until next time, stop paying fees and start building wealth.